Hi, this is Professor Hazara again, and we're going to go over four types of foreign currency transactions. And like I keep saying, is that this is the traditional way to do the hedging that we're going to do. But it shows the logic. It's not the way you do it nowadays. It's similar. There's similarities, but we'll get into those videos in the next series of videos. But first, I'm going to show you what, how to account for an unhedged, or we call exposed, net asset position. Then I'll show you how a net asset position is hedged. And the accounting, I'm going to do the traditional way. And then a little later on, we'll get into how it's done more nowadays, at least give you an introduction to the rules. Okay, an exposed net asset position is when you sell something to a foreign firm, usually inventory to a foreign firm, on credit, and when the account receivable is denominated in the foreign currency. Okay, so this is just a basic transaction, but it's pretty easy. This is pretty basic stuff. So let's go to the transaction here. So we have three transactions. On November 1, 2015, a U.S. company sells and delivers 10,000 teapots to a British firm for 300 British pounds. Okay, so you're going to sell them 10,000 teapots for 300 British pounds. And we're going to make the assumption that the receivable, we're going to make the assumption all through these examples, or else it would be irrelevant, that the receivable here is denominated in British pounds, which means that when the British company gives you the 300,000 British pounds, 300,000 British pounds, the receivable is settled. The problem, as you're going to see, is going to be that between now and the date you collect those pounds, the value of the pounds, and hence the value of the receivable, fluctuate with changes in the exchange rate. Okay, now the current exchange rate is $1.60. This is the direct exchange rate, which means that it costs $1.60 to obtain 1 pound, that's gonna affect the value of your receivable here. Okay, so there's three transactions. That's the first transaction. The second transaction is on December 31st, and the relevance of the transaction is the firm closes its books. Now, at this point, the exchange rate has gone from the spot rate has gone from $1.60 to $1.70, which means that the account receivable is actually worth 10 cents more per pound. So your account receivable actually, because it's being paid in pounds and each pound is worth more, that means your account receivable is worth more. And according to GAAP, you have to show your receivables at their true value, their net realizable value. Then we come down here to transaction 3, which is when the transaction is settled. And that's in the next year, you'll notice. And when the transaction is settled, the British pound actually is down to $1.20. So each one is worth only $1.20, which means the receivable has really gone down in value. So we have a situation where you start with $1.60, the value of each pound goes up to $1.70, then goes down to $1.20. So you can have a gain here and a loss here. Okay, so let's do these three journal entries here. Okay, let's put the date in. The first date is November 1, 2015. Okay, and we'll put the accounts here too. This is just a regular credit sale of something. So we're going to put account receivable. It's going to be debit account receivable, credit, sales revenue. But I'm going to put an FC beside account receivable. When I put an FC beside either receivable or payable in these transactions, it means that the account is denominated in that transaction. And keep in mind that we have to do this because U.S. companies report in dollars, and so you have to show the dollar value of those 300,000 British pounds at whatever date and time you're dealing with. So we're going to debit account receivable, and we're just going to go ahead and credit sales revenue. Okay, and here's what we're going to do. We're going to do this we know that it's 300,000 British pounds, so that's your unit. The rate for each pound is $1.60, $1.60 here. I'm going to go ahead and, if I get this in here, I'm going to go ahead and, just to make sure, let's go ahead and see if we can put a dollar sign there. That looks good. And why don't we do this? Because Excel does do this, and sometimes reports you have to do this. Let's look at the currency function here. and we'll leave off the zeros there, but let's go ahead and English pound. Let's see if we can get the sign for the pound here, which is, I think, kind of neat. Let's see, if not, we'll, I think this is it right here. Okay, so there you go. British pounds. So you've got dollar. Our account receivable is going to be, they're going to give us 300,000 British pounds. Each one is worth $1.60. The value of this receivable, and in essence, that revenue, well, the receivable is going to go up and down as the exchange rate goes up and down. So let's just go ahead and do this. We're going to take 300,000 times $1.60. It's going to give us $480,000. So that's what our receivable is worth today. It will go up and down as the exchange rate changes. Okay, and of course our sales revenue is equal to that amount right there. Okay, so that takes care of this first transaction right here. The next transaction is just simply you have a date in which you close your books, which is December 31, 2015. Okay, and the only thing that happens, there's been no exchange. There's absolutely no exchange of currencies or anything here. The only thing that has happened is that your the value of the pound is now $1.70. So that means we're going to go ahead, and the current rate here is 1.7. So the value of the pound changed went from $1.60 each pound is worth to $1.70, which means that those 300,000 British pounds, each one's worth 10 cents more. So you're going to record a gain on your income statement of 10 cents per pound. Okay, so that's the original exchange rate. This is that's the new exchange rate. This is the original exchange rate, and we're still going to have 300,000 British pounds. Let's go ahead and change these to dollars. And it's kind of neat, I think, that Excel does this, but it's neat because bring this down here. I mean, Excel is, in essence, I mean, it's meant to be a program for handling monetary units. Okay, so we're going to have a gain. So the value of our receivable goes up, so we're going to debit the receivable, and then I'm just going to call, obviously, I'm going to put exchange gain. Obviously, you'd call it something more formal for you in real life, but I'm just going to put that for exchange gain. And this goes to the income statement, by the way. So this goes to the income statement. Okay, and so we're going to record, here's going to be the amount. We're going to record a 10 cent per pound gain in the account receivable. So we're going to take 300,000 British pounds times the difference, going to be equal to that number right there, times the difference between $1.70 minus $1.60. So we have an exchange gain of $30,000. And why is that? Because each one of those 300,000 British pounds is worth 10 cents more. So if we close this out today, if we collected those out today, not only would we have sales revenue, but we'd also have an exchange gain. Of course, there's a bit of gambling here because the rate can also go down. Okay, now we come to the final transaction. This is when the account receivable is settled. That means that they give you 300,000 British pounds. You've got to record the account receivable cash, first of all. You've got to record the cash and the account receivable, because you're not getting dollars, you're getting $300,000 British pounds here. So you got to recognize that the dollar equivalent, how much the 300,000 British pounds worth in US dollars, and you've also got to write off the last balance of the account receivable account. Okay, so let's put a T account up here. This may be overdoing it, but I'll go ahead and we'll put a T account here, and we will, this will be our account receivable. And I think you can see this anyway, but let's go ahead and put it up here. This is our account receivable balance here. Okay, and we've got two entries from entry 1, November First, we have a debit for 480, and then we have another debit for, I think, another debit for 30,000. Okay, and the first entry was on November 1st. Second entry was on December 31st. So going in to the settlement, our balance going into the settlement, final settlement, is equal to $510,000 going into our settlement here. Okay, so we're going to settle this, as it says in the transaction here, on February 28, 2016. So we're going to put in here February 28, 2016. Okay, and here's the entry, and it's kind of not strange, but we're going to receive, I'm going to put FC there because we're receive foreign currency, the British pounds. But keep in mind that in spite of the fact that we receive 300,000 units of foreign currency, our reporting currency, because we're a U.S. firm, is the dollar. So we can't report pounds. What we have to do is report the dollar value of those pounds. So we'll do that, okay? And then we're going to write off the latest balance of our accounts receivable. So we're going to have accounts receivable. I'll put FC beside that. And then it looks to me, since the value of the pound has gone down to $1.20, it looks to me like we're going to have a rather large, it looks to me like, exchange loss, because each pound has gone from the latest value of $1.70 down to $1.20. So since our last revaluation of the account, they've gone down 50 cents per pound. So we're going to take a bath here. Okay, so let's do this. We've got 300,000 British pounds. I'll just do this. See if we can put this down here. And our latest rate is $1.20. You have to use the latest rate and compare it to the current rate, which is $1.20, to the latest rate that you adjusted to, which is $1.70. And you can see there's a 50 cent per lost pound in there. So what we're going to do is we're going to do the cash that we receive is going to be worth 300,000 British pounds times $1.20. So we're going to take a bit of a bath on this thing, because each pound is worth $1.20, which is 50 cents less than the last recorded rate that we used to adjust the account receivable to. It looks like we're going to take a rather large bath here, but let's see how much it is. It looks like it's 50 cents per over 300,000. We're going to lose $150,000 is what we're going to lose. But let's go ahead and get this. Okay, and so the first thing to do is record the dollar value of the cash that you receive. You got it. The British company paid you this cash. That's why I put the FC there. They're paying you 300,000 British pounds. Okay, that's why I put that FC there. Now the account receivable, the latest balance was 510,000. Which should I put this up here? Okay, which is that right there. And you can either just take the latest balance of the account, or you can take 300,000 British pounds and multiply it by the latest rate that you adjusted to. You'll get the same amount either way. And now the exchange loss. Exchange loss obviously is going to be 510, which is what they were worth back at the end of last year, and what they're worth now is 150,000. So one way to do it is you can just take the plug. The more logical way to do it is to recognize that you've lost 50 cents for each one. And I'm going to put this in here, is you could also take, besides just taking the plug, you could also, and that's what I'm going to actually record this here. You could take 300,000 British pounds and recognize that you have lost 50 cents on each one. So it's times the difference between $1, it's times the difference between this $1.70, which was the last rate you had adjusted to, and the current rate, which is $1.20. Also get 150,000 that way. And of course, it's not a credit, excuse me, it's a debit. So you've taken a rather big bath. But so notice that your total, if you were asked what was your total exchange rate or gain or loss summed up on this one, you would say our total exchange loss, we lost 150,000 ultimately uh, in 2018. Excuse me, this should be 2016. Put that. So we lost 150,000 this year, but we gained 30,000 last year. So on a net basis, you had an exchange loss over the years, over the entire transaction of $120,000. Um, but the impact, the just like all accounting, you've got to show the value. You've got to show losses and gains in the year they occur, matching principle. Okay, so this went on to the income statement. So I'm going to say income statement for that loss went on to the 2014 income statement, and this loss here went on to the income statement. I was going to copy this down. This loss here, that gain was shown in 2014, and this loss here is shown in 2015. Anyway, that's just this basic idea: is you sell something, but the account is denominated in foreign currency. So since the foreign currency you get fluctuates with the exchange rate, the value of the receivable fluctuates. In the first year, it went up by 10 cents per 300,000 foreign currency. So in dollars, you had a gain of 30,000, which is 10 cents times 300,000. Then it went down from $1.70 at the end of last year to $1.20 at the date this was settled. So you lost 50 cents, which is 50 cents for each one of those, 150,000. So you split the gain or loss, $30,000 gain here. This year, $150,000 loss there. So you lost 120,000 on exchange rate losses. Of course, I exaggerated this for illustrative purposes, but you split the recognition of you made 30,000 this year, lost 30,000 last year. That's against revenue notice of 480,000. So times of extreme volatility, you do want to do something to see if you can minimize the fluctuations in a currency, especially if you're dealing in emerging market currencies like the Mexican peso or something. So that's why we hedge transactions, which is the topic of the next video. Okay, so let me put this video up, and then we will go from there.